Hi, I'm Jared Snider with Exential Wealth Advisors. I'm a partner and senior advisor here at Exential, and I'm here with Alex Klingelhoeffer. Hey, Alex.
Hey, Jared. Alex Klingelhoeffer, OKC, CFA, CFP on Twitter. Happy to talk with you folks today about an important topic. We want to talk about asset allocation. What do we put in a portfolio? How do we think about it? And how might we fit a client to an optimal allocation that's going to help them and their family out?
Yeah. I think we get this question all the time from clients because whenever you look at the investments that you've accumulated over the years, a lot of times things can get cluttered. A lot of times things can get overly complex.
It can be a mess.
It really can. So what we try to do is help our clients simplify things. And one of those ways that we help clients simplify is by classifying assets in one of three buckets. We classify things in those three buckets because it gives every single asset class a job, and it helps us to understand where it really fits in the overall mix, right?
Yep, three buckets. So income or preservation, that's going to be inflation hedging assets, and then growth, right? We all want growth. We want it yesterday.
Right.
I'll take my portfolio doubling yesterday. It's not realistic, but hey, we want growth, and we want to hedge inflation, want to have income preservation. So, Jared, in that first bucket, and that's really the cornerstone of our investment process, is the income and preservation bucket. What do we put in that bucket?
Yeah, a preservation portfolio, that component is really about high-quality fixed income. Interest rates are very low today, so we don't get paid a whole lot from a return standpoint to load up on bonds. But we think that bonds and other similar conservative investments like cash and cash equivalents, they have a place in portfolios as a source of ballast, and they also provide a kind of a rainy day fund. We call it a war chest.
Yeah, war chest. So typically we want to know, first and foremost, what cash flows you need out of a portfolio. Are you spending 5%? Are you spending 10%? These have very significant impacts on how much of a ballast you said we need in choppy markets. And then there's the second bucket, Jared, which is hedging inflation, right? We all know inflation happens. It's coming. It may be 2%. It may be 3%. Back in the 70s, it was 7, 10%. What do we do to fix that?
Yeah, we think that there's a category of assets that hedge inflation really, really well. And there are a few different assets that go in that bucket of inflation hedging. So things like infrastructure companies, MLPs or master limited partnerships are good examples. Companies that are in real estate or REITs, real estate investment trusts. Yeah. And then direct commodity exposure. Those are all investments that help us whenever inflation starts to run. And we're in a time period in the market right now where that's kind of the $1 million question.
Everybody wants to know about inflation.
Everyone wants to know, is inflation going to start running hotter? Still very, very low, but if it ticks up and we see more inflation, having an inflation hedge in your portfolio can really be a fantastic tool, right?
Yeah, of course. You always want to make sure that you have something that's an ace in your back pocket that's going to help you in times where inflation expectations rise and inflation rises. And our third bucket's your equity bucket. What you think of when you think of, hey, I'm going to go meet with a financial advisor who's going to tell me to buy some stocks. Well, yeah, we, of course, want to own great, high-quality companies that are going to grow their earnings and provide returns to shareholders. That's part of the game of investing, is trying to make returns for clients. Typically, we like to have a mix. We think most markets are worth owning at almost all times. Now, sometimes we'd like to own a little bit more of one market than another. We tend to like large caps versus small caps, meaning large companies over small companies. We like U.S. companies because there's transparency and regulation better than international companies. Can you touch on some other things we might like to think about when thinking about putting some assets in a growth bucket?
Yeah, the growth bucket is really just that. It's the engine for returns in most of our client portfolios. Again, just kind of thinking about what we were talking about earlier with low interest rates. So that equity bucket, that growth bucket, is the engine to make things kind of happen in your portfolio. And it's just owning publicly traded stocks around the world, large, middle-sized, small-sized companies, whether they're domestic or overseas, and really having a great plan and approach to that. There's a lot more we could talk about equities, but that's the growth bucket.
Yeah, that's the general idea of how we come to an allocation. Now, how do we combine those three buckets? Well, first and foremost, we want to look at your cash flows, decide how much we need to keep in preservation assets versus how much we can afford for growth, because we're really trading off, right? We're trading off between the risk of running out of dollars versus the risk of selling when the market's bad. We want to make sure that we don't have either of those two risks too present in the portfolio. And I think that's what helps determine us the ultimate allocation of a portfolio.
Yeah, that there are a couple of twin risks that go together. There are many risks you have to account for when you're creating an investment allocation. But depletion risk and then liquidity risk, or really lack of liquidity as a risk in a portfolio, are two important things to be managing. So on one hand, the depletion risk management requires owning enough assets to be producing growth in your portfolio that, as you get to the stage in life where you're withdrawing money out of your portfolio, you're not withdrawing the money to such a degree that our portfolio isn't able to keep up and our return isn't good enough, and we end up running out of money before we run out of years, which is kind of everybody's nightmare scenario.
Yeah, if you and your spouse are both 70 years old, both made it to 70, odds are one of you is going to live to 90. We need to prepare for that.
Yeah, and I think a lot of people in their 40s and 50s and 60s may not really think about that, but age 90 is a real possibility for a lot of Americans today.
Sure is.
So managing that depletion risk aspect is huge. The other risk is the liquidity risk management piece, and that's where having your war chest of stable investments in the preservation bucket that we talked about a minute ago is really important. I can't pound the table, Alex, and say that returns on bonds are really attractive.
Yeah,
right?
no, we're going to own them because we have to, because the market does not always go up and to the right in a straight line, and we accept that in real terms they might sometimes have negative returns. We're okay with that because we have other assets to offset that.
That's right. There's really a planning reason to own bonds. And so whenever we're helping our clients to craft a portfolio allocation, generally there's going to be a range of allocations that we're able to present to our clients. It may not mean that you should have exactly 72% of your money in equities and the rest in preservation assets. There's probably a range of, maybe it's 65 to 85% equities is reasonable, and then we know the minimum amount that we need to have in those preservation assets. So there are a lot of different ways of approaching it, but at the end of the day, what we want to help our clients do is avoid the destruction of capital that can happen if you don't really pay attention to risk and real true risk in the marketplace. Avoid the destruction of your capital, avoid lost purchasing power over time, and just continue to see growth, because growth is really important, especially when you do get to the point that you have liquidity needs in your portfolio.
It's tide that lifts all boats.
That's right. Well, hopefully today's conversation has been really helpful for you, just thinking about how investments kind of fit in these different buckets and maybe how to put these different strategies together. We're always happy to be a sounding board for you. Alex and the team and I are always available anytime. So you can reach out to us. We've got our contact information on the screen. We also have a number of webinars for different companies specifically designed to help you think through these different things. And we would love to continue the conversation with you. So don't ever hesitate to reach out. Hope you have a great day.
Thanks.